Okay, let's try to go over this as if we have not been in this, as if we have not learned anything, and as if this is our first day figuring out what the hell this shill guy is talking about. So let's look and go back to the core logic of the strategy and just go over it one more time. So, KISS, that's my favorite thing to use, and it's keep it simple, stupid method. Now, what's the first thing we look for in these plays? The very first thing, gaps on the daily chart. No other time frame you should be using to find gaps except on the daily if looking for an initial candidate. Now, also, on top of that, you want broken RSIs for calls. In other words, you want an RSI either at the 30 line or below it. And then you want it also to be near or below the 52-week low if you're playing a gap down, and near or above the 52-week high if trying to play puts from a gap up. Oversold RSI for puts plus gap down, as you see here in this image. You know, right here, it got a little bit oversold. Actually, a lot of oversold. And you can tell it's naturally trying to come down to this gap to fill. But now we got a gappity gap, double gap. So this one's looking very good for a nice put play. This is I think G bio. So yeah, good shit. But yeah, that's basically it. So gap, find gap, gap found, likely on earnings, and then you check to see if that gap has pushed the price above or below the 52-week high, depending on if it's a gap up or down. Now, why are the gaps the most important thing? Well, because it's a void of price action. It's a broken, fragmented chart. So if you look in the case of GBio, and I'm sorry, the last chart was not GBio. I'm retarded. I honestly forgot what that stock was. But you get the point. You see, on the day of earnings, it comes down, or this actually may have been a mid-cycle. But regardless, if you're new, you're not going to be looking for gaps. You're not going to be trying to catch gaps. You're going to be playing the plays, hopefully, the same day it gaps down. Because you see here, it goes from 8.7 or 13.48 down all the way to 550. So if you would have bought this call if you would have timed it on the 1 minute MACD on the day it gapped down, whatever time frame that was during the day, you would have had very good returns, because if you would have bought it this wick here, it never returned to that point. So again, if you would have bought slowly here and held it all the way through, you would have been in good shape. Because in the money, intrinsic value negates theta. That's why we're doing this. Because if they have it trading sideways just outside of out of the money, and you happen to have bought that strike, like today, for example, we saw that happen with what was it, GIS. It was I bought a 65 call. It went under 65. The theta immediately started draining it. That's just how it works. So you got to stick to in the money. There are exceptions, of course, but generally, if you're just now starting this out, in the money calls, make sure the IV looks good, and that's basically it. So we're finding the gap. We're buying the in the money calls on the day it gaps down, or the puts on the day it gaps up. So again, here's another example with Kirk. If you would have bought calls on day one, this is why I want, and you should be buying in slowly, because you want to time your buys on the lower end, if you can, of the first candle on the gap down. So if you would have bought Aggle somewhere down here, and then it goes against you, then you can average down. But for your initial buy-in, this is the 1 minute chart on the day that Aggle got, or this is Kirk actually. This is the RSI and MACD in 1 minute chart on the day Kirk gapped down, and you can see this is the 52-week low right here. Is the 1321. So obviously that would have been the ideal time to buy. Your MACD signal almost hit it directly on it. And then you also have the RSI you can look at as well. When the 1 minute RSI gets down underneath that 30 mark after a gap down, that's a great time to make your initial purchase. And then the reason why we want to do it slowly is because if it goes against you, like it did here, like we see we get a gap down, we have a nice gap down. If you would have bought here, you had 2 more days of red, right? That's why if you buy slow, you buy 1 this day, you buy 2 more this day, you buy a few more this day, and then your average is going to be real close to where you initially bought here, as far as a percentage point wise. And then look, you had 1, 2, 3 with a period of 3 bad days, and then really good day, you would have been making money, especially if you were in the money. So just keep that in mind. It's very simple logic. Anything brought in from the outside, like news, it's meant to distort you. That's what it's literally designed for. I see it all the time. People, they do a great job getting away from the media, but then they see something that fits the narrative and they get right back into it. So if the contracts are expiring the week of, this is when you verify max pain is above the current price for calls and ensure the max pain is below the put plays, because max pain changes. So it's a week to week deal. So if we see a gap and we have a call option expiring the week of, and we see that max pain is below that price, but there's a gap to the upside, like what we saw with HQY last week, that likely means they're pushing the max pain back a week, just like what we saw with HQY. So that's why max pain can get you a little fucked if you're not too careful. Max pain is only most important on the last week, maybe even week and a half heading into expiration. But until then, just ride it out. Ride it out. There's a gap. We've seen it. Every time the gap's down, every single one of these plays has tried to change course and go towards that gap with some positive momentum. And that's literally all this is. We're not playing the gap fill. We're playing the gap momentum of the correction. Now, if new, we should only be focusing on stocks that have earnings coming up. There's literally a calendar. It takes all the guesswork out of you. All you have to do is literally just go through that calendar and see and look for gaps. Now, if there's not one, you wait. You wait for the earnings to come. You see which direction it gaps, and then you buy the call or put, depending on which way it goes. We're simply playing off the momentum of the correction from the gap, that void of price action that you can think of like a black hole, drawing everything back up to that zone. Now, if you're playing a call or put and your stock or security that you're in happens to get into that zone where there's no price action, that's badass, because 9 times out of 10, when it gets into that zone, it tries to fill the entire void. So keep that in mind. And then lastly, max pain, PCR, is used to refine our outlook headed into the week of expiration. Because, if we take that out and we're 4 or 5 weeks out and we have a gap up onto the upside, there's a 90% chance you're going to get to play off some momentum. I mean, 9 out of 10 is not bad. So news articles, price targets, and other information will only dilute this logic. News articles, price targets, and other information will only dilute this logic. And the exceptions are dividends, company mergers, buyouts, and splits. Avoid large name players like Nike, too much ETF manipulation. We want low volume stocks, ghost town stocks, hopefully in share lending vehicles that no one is touching, and we can get away with this. But big namers, maybe not so much. So in essence, is there a gap? If so, it must be earnings time or midway through. There's 2 criteria. There's a mid-gap cycle for earnings, and there's a earnings gap cycle. So if the gap isn't there yet, wait for earnings to come. If you're new, if you're experienced and you think you can time the exhaustion gap, it's counterintuitive, so be careful. If you see something like CDNT like we saw today, it's clearly in a downtrend. So that's why you buy puts before the gap to try to catch it and then immediately revert to calls, and vice versa on the uptrend. So literally the process is this. If you're new, is there a gap on the daily chart of this stock that has earnings either tomorrow or the next day? No? Okay. That means we can assume there's likely going to be one. Throw it on the watch list. Wait for it to gap. Every day you're in the market, if you're new, the easiest way to go about it is when 8:30 opens up, go to your earnings calendar, check which ones have earnings that day. Check and go through them to see if any of them happen to have gapped down in pre-market or gapped up in pre-market. There's your play for that day. And guess what? You got it at the perfect time, because since it just gapped and the market just opened, all you have to do, flip to your 1-minute MACD, flip to your 1-minute RSI, wait, and time your buy. And that's literally it. And let the momentum from the in-the-money calls guide you into the sunset. But seriously, it's not that bad. So again, gap, if so, must be earnings. 2, if gap up is in the money IV acceptable for puts, use the Black-Scholes calculator. There's a tutorial on the README page in the Discord if you would like to know how to do that. But yeah, you want to look for anything under 160. I mean, I like to personally cut off at 160. Everyone's risk tolerance is different, but the sweet spot is between 40 and 90%. And if there's a gap down, are the in the money calls and IV, or I'm sorry, if the gap down, yeah, is the in the money calls IV acceptable? And reference it with the Black-Scholes calculator. Now, 3, do the gaps up and down break the 52-week low and high? Does it break the RSI on the downside and the put RSI into overbought on the upside? So, gap, yes or no? There's a gap, cool. I'm going to play whichever direction it needs to fill. If there's not a gap, that must mean earnings is coming up soon. So I'm going to wait until earnings day to see if it does in fact gap pre-market or after hours the day before. Once that occurs, you play the direction of the gap. If trying to catch the gap, you play the direction of the exhaustion gap, and then you play the direction of the fill. So hopefully this all made sense. It's very simple. So if you just started, again, I'll do one more time. Gap, play the fill, or the direction of the fill. If there's a gap, play the direction of the fill. If there's not a gap, play the direction of the exhaustion gap if you think you can catch it, because that's likely what we see happening. But to make it easy on everyone new, don't even worry about catching the gaps. Just sit there, wait for earnings to come to you, find those gap downs and gap ups because they will be there, and then buy the appropriate call or put based on where that void is in the chart. And then to time your buys, 1 minute MACD RSI, ideally when it's broken on the 1 minute on the downside, near overbought on the 1 minute on the upside, and it's the same shit every single time, and this should be viable hopefully for the next few months. So hopefully this helped. You have a good one. I'm going to go get baked now.